Hey everybody, we made it to the end of the trading week. My name is Brent Moores. I'm sitting in for Ben Watson today, who's out at a workshop. He's in Chicago right now. So I'm sitting in for him. Glad to be here. He should be back next week, I think. But I'm also joined by Cameron May, who's in the chat helping me out today. So as you have questions, feel free to type in your questions to Cam or myself. We'll do our best to get those questions answered. We're going to go through the markets. Well, I'll show you. I have a slide on that. Just one sec here. But first, did I mention X? You can follow us on X at Brent Moore CS, at Cameron May CS. And it's been quite a week, hasn't it? Well, let's go through some disclosures here. The information today I'm going to go through is for general informational purposes only. It's not a recommendation of any security strategy or chart type. And we'll look at different securities today. We'll look at stocks. They're not going to be recommendations though, right? We'll look at them, see what they did, talk about some news perhaps on some of them, but there's no recommendations today. Options, probably won't be dealing with options today, but in case we do, options do carry a high level of risk and are not suitable for all investors. And paper money application, the Thinkorswim desktop software paper money application is for educational purposes only. Schwab does not recommend the use of technical analysis as the sole means of investment research. And past performance is not even a guarantee of future results. All investing involves risk, including the risk of like losing it all. You're right. If you buy a stock, it could go to zero. Good to see some familiar names in the chat. Glad to have you. And those of you who are new, we're glad to have you as well. Greg said TGIF. Man, this has been a week in the markets, but last week was too. In fact, this week I'm actually probably feeling a little better than last week. We'll take a look at that. But this is what we do in this webcast. We look at the general market indices. We'll look at different indices there. We'll talk about some of the things that move the market this week and talk about next week as well. Some things that are coming up next week. General trends, different time frames, support and resistance areas, and stuff like that. Okay, so that's where we're going with this. Let's bring up the Thinkorswim paper money. That's actually not a terrible candle there to finish it up there. That's TMTM said that as well. You know, this is the S&P 500. You know what we've done this week, or what we've done the last, better part of a month now, I guess. We've gone down. This would be a pretty significant break. We didn't see that this week. That's good. We'll take that as a start. This was Monday. Monday was right here. Okay, so here was the high on Monday. I'm going to put a little dotted line right there. That would have been nice to break through. We didn't get there, but we did end up with a positive candle. And furthermore, if we were to look at weekly candles, let's look at the weekly data here. Let me just do that. Zoom in. We broke the streak. We had 4 down weeks in a row, folks. We actually had an up week. So that's good. That's good. We'll take what we can get here on that. So, you know, you could use shorter term indications on that. But, you know, so my feeling, it wasn't like the strongest bounce in the world, but we held our own, and it wasn't a quick bear flag either on that, right? And so it looks like we're at 56.67. Let's look. So here's the S&P 500. Obviously, those are weighted a little fairly heavily. It's market cap weighted. If you look at the SPX-EW, this is the equal weight index. Kind of similar, but yeah, not the greatest close here on that equal weight index. Okay, so we closed right at a previous support level I had drawn in here, which was kind of the close open price back in January. We had breached that there. That's where that was. We regained that, and well, I guess we're not below that line. That's a good sign, I guess. But definitely more weakness in the SPX equal weight versus the S&P market cap weighted index. Let's take a look at the NASDAQ here. Here's the NASDAQ 100. It looks a lot like the SPX, doesn't it? I'm not going to belabor the point, but I would say the same thing. Here we had a nice, that's actually a bullish kind of engulfing candle there on the NDX. That's a good way to finish the week on that one. By the way, I have 20 and 50-day moving averages on the chart if you're interested. We're well below both of them. That's a potential resistance level. Furthermore, what I'd say is, yeah, that's a resistance level, probably kind of up here. Where our highs have been, we haven't been able to hold. We tested it there, didn't we? We tested it there. We tested it there. Didn't quite get there today, but so, we'll see how we go. Not the most volatile day. Today was a triple witching day, So what that is the monthly equity options expired, index equity options expired, and options on futures expired. You tend to get more volatility on those days. So not terrible in that regard. In terms of the major indexes, let's finish that up with the Russell 2000 small caps. Looks a little different than that NASDAQ and that in the S&P 500. On the others, they were a little more flat. On the Russell, we actually had more of a bounce this week, okay? More of a bounce, but then not a great close on this, down 0.5%. But one thing I mentioned earlier, I was actually on Trader Talks this morning, and something I mentioned is, yeah, we had a bigger bounce on that Russell 2000, but we had a bigger drop too. I mean, this was like a 20% drop from there to there. Okay, the drop started earlier. The drop started in November on the Russell, 20% drop. Look at the S&P 500. Where did it start? It didn't start in November. In fact, we hit an all-time high in mid-February this was a quicker drop, about 10%, I think, high to low. And we regained just a little bit of that. Now, what is kind of driving the markets, I think, is that kind of begs the question here. And of course, we had news events this week, and we'll look at some individual stocks here in just a little bit. But one of the news events was the Fed, right? On Wednesday, we had a Fed rate announcement. And that rate announcement was we were going to maintain rates where they were. In fact, I have the Fed Watch tool here somewhere. There it is. Remember, this isn't TD Ameritrade, or excuse me, this isn't Thinkorswim. This isn't Schwab. This isn't a broker. This is the CME Group Fed Watch tool. This is based off of Fed futures data as to probabilities here. But the current rate right now, the current target rate on the Fed funds rate, these are the probabilities for May. Going into this week's announcement, basically they were 99% that we were going to stay put, which is what exactly happened. The markets seem to react relatively positively on that to Jerome Powell's comments. And that's often the deal, is it's not just what the rate announcement is, it's kind of guidance for the future. Same thing with individual stocks and earnings. It's not just what they did, it's expectations for the future. Chairman Powell talked about the labor market, and he seemed fairly confident in the labor market. There have been some signs of weakening in the labor market, but he didn't seem too concerned about that. That seemed to give the market some ease. He said most of the uncertainty right now for the Fed, and of course that uncertainty filters down to future interest rate decisions, future monetary policy, is the most of the uncertainty right now is related to either this whole, kind of tariff uncertainty is one thing he cited. Inflation uncertainty is another thing he cited. On the inflation front, it's certainly come down from peaks. that we've had. But, he did mention, he actually brought back up, I don't know if you guys caught this, he used the term transitory again, which gave some people some shell shock, I think, because, last time they were kind of floating around that term transitory, it certainly lasted a lot more than, I guess everything's transitory if you have a long enough time frame, but it certainly didn't come out very well last time in the post-COVID inflation. But he did, and he was called out on that to a certain extent on the presser and the questions he had, in terms of what's different this time. And he acknowledged that, yeah, we didn't, it didn't work out very well last time. But this time he said, the market is different and the causes of inflation are different now. We had huge multi-trillion-dollar fiscal stimulus before the previous inflation push. They're trying to get that inflation down to that target of 2%. Okay, that's always the Fed target is 2%. Not always. Well, that's the Fed target is 2% basically. And the feeling is it's going to stay above there for a little while. But in terms of interest rate policy for the rest of the year, you can see in May, basically, the odds are, according to this, for what it's worth, and not a guarantee, high chance it stays right where it's at. But as you go to mid-year, later year, here's June, you can see it changes. This is where we currently are at. No, excuse me. This is where we're currently at, right there. And you can see the odds are spread out among different possibilities here. This is kind of like it's kind of like a weather forecast. The farther out you go, the less certain it becomes. Well, same thing here. So as we get closer to that June meeting, you'd expect the probabilities to even out there a little bit. Going to the end of the year, though, I didn't click on the end of the year. Hold on. There's the end of the year. I think I clicked on the wrong date. Anyway, my point is it spreads out. I think I went out to 2026. That makes more sense, 2026. But you can see by the end of the year, we're looking at a couple at least there. But that's kind of their dot plot, which I'm not going to take the time to go into right now. But the dot plot they're predicting 2 rate cuts for the year. There's the interest rate we can look at. Here's the 10-year. Here's the 10-year rate. You can see we had a nice little drop, and that's helped out the housing market, of course, and it helps out other things. It helps out companies that have debt financing, of course. But another thing, and what you kind of want to see, I think, for a lot of people is a gradual easing, a gradual lowering of those rates. If you get a real rapid lowering of the rates, that could be signs of significant economic weakness. So that's probably not what we want to see. Probably want to see that, trend continue down. I think a lot of people would like to see that. Another thing we'd like to see is the yield curve. This is the 10-2 yield curve. So in other words, it's the 10-year rate minus the 2-year rate. And the 10-year is typically going to be a higher rate than the 2-year. And so you generally have a positive yield curve. This is the 0 mark on this. So this would mean the 10 and the 2s are the same. Anything below this yellow line I'm drawing, represents an inverted yield curve. So we had that from here to there. That's kind of a cautionary sign. We notice we have jumped back into a positive yield curve territory, which is good. And this is this increasing curve is generally a positive sign for the economy there. Okay, so that's that yield curve. By the way, if you are interested in ever pulling that up, one way to do that is you can go to the Analyze tab, go to Economic Data, and then you can go down to interest rates, which is right there. And if you scroll down, it says interest rate spreads, and then it's the top one on your list there. Okay. All right. So that's enough about interest rates. Let's move forward with looking at the market. I kind of started the webcast saying, it's been a tiring week. I'll tell you, it's been a tiring week, but less tiring than last week. And I think that's reflected a little bit in the VIX. This is implied volatilities, kind of market fear gauge indicator. That's eased off a little bit. So we're down now under 20, which is still fairly elevated, but definitely off the peaks where we were on that. So, in terms of options, trading, options are less expensive than they were a few days ago, but still relatively elevated. Now, let's look at some individual companies on the move this week. One thing I'd like to point out, though, on these is I'm going to look at some Mag 7 stocks. And the reason is when we talked about the kind of the discrepancy, the disparity in performance between that S&P 500 and the S&P 500 equal weight, a lot of it is these big like Mag 7 stocks. And for the most part, they've really had a terrible year. Meta is positive, I think, for the year, but that's it. So I thought maybe we'd look at them. So here's NVIDIA. Now, Jensen Huang, who's the CEO, he had a kind of a, I don't know what you call it, a press conference. Is that what you call it? This week, and it made some news. They've performed. They're well off their lows, but obviously well off their highs too. These big companies can certainly move the markets pretty significantly. Okay. In fact, let's do this. Let's go to a year-to-date chart on this. And let's go to keynote. Thank you. David's like keynote address at a conference, not a press conference. He was the keynote address. So thank you for clearing my mind up there. Okay, let's go to a year-to-date chart. So I'm just going to go to my time frame and let's put it in percentage terms. Okay, so let's go here and we'll just see how poorly some of these have done. I didn't do that. I didn't click on it. Here's year-to-date. Click OK. There we go. And then I'm going to just click on this little squiggly line here and show price as percentage. So how has NVIDIA done this year? NVIDIA is down about 15% this year. So that's one of your Mag 7. That was really one of the market. If there was one stock that was market leader probably last year in 2024, it was NVIDIA. Here's another one. And I'll talk about Tesla a little bit more here in just a bit. Let me just give you a brief view of Tesla. Tesla down 34% this year to date. Meta, I mentioned that was the one that was doing a little bit better. Just negative for the year. In fact, today was actually a pretty good day. A little bit negative for the year. By the way, for reference, the SPX is where are we? Down about 3% for the year. So Meta's actually outperformed the SPX. But Microsoft down 6%, 6.5% this year. Amazon down 11% this year. Apple down 10% this year. Now, Apple just had some news. They replaced their head of AI on Apple. And I think the feeling was, they kind of had this, I'm certainly not an expert at this whole AI, Apple's integration with AI, but it's been they have not benefited, they have not performed up to market expectations for to the promise that they felt for their AI. So they replaced their head of AI and, they've struggled a little bit. I saw that they were losing currently $1 billion a year on their Apple TV Plus segment of their business. That's unfortunate. So you can see that reflected in the performance here. So let's see, what are their Mag 7? I think Google, Alphabet. Okay, there we go, down about 12% or so this year. So that you can see that underperformance on that Mag 7 driving the markets down this week. Now, there were a few names. Let me just go back to our kind of normal charts here. I mentioned Tesla. Let's look at Tesla. So, because Tesla, you guys know the narrative. They are struggling. They have increased competition abroad, particularly. And also, you know, the political winds are disfavorable for some people in terms of their CEO, Elon Musk. And that seems to be affecting the stock. In fact, it is affecting it so much that what am I doing? There we go. That right now, how far are we off from our highs? We're off about 50%. We're right about 50% haircut, so to speak, on the stock price right now. Now, I'm going to zoom in a little bit just so you can see a little better. But one thing I would point out, I pointed this out on X earlier today. Today was a good day. Okay. Yeah, BJ said, yeah, 50%. That's a lot. That's a big move. But today we're up 5%. That's good. I mean, 5% is great on any market, but especially on this right now. It is maybe bumping on up against some resistance, perhaps. That's where our highs were over the past couple weeks. Number two, we actually got kind of a mini little higher low here on this. So yeah, and Wiley said, did I hear they were calling it trucks? Yeah, their cyber trucks there's a panel, I guess, evidently on the cyber trucks that was coming off. It was the news I was reading on Tesla. And well, it didn't seem to, that came out before the market closed. It didn't seem to affect it too much there on this. And Speak Truth said it's kind of a roller coaster. Yeah, after the election, Tesla actually really had a really strong rally. So there we go. So that's Tesla, very choppy right now. Other stocks in the news. I saw someone mention this earlier. Boeing, which you guys have known the travails of Boeing over the past few years. And, starting really with the whole 737 MAX, this goes back probably 5 years at this point. They've really struggled. Lately, they've really taken off. I mean, that's a really nice run here over the past. I mean, we were down at 145-ish. Now we're up to 178 percentage-wise. That's a pretty good run just over the past 2 weeks. In the midst of what was the rest of the market doing? That makes it perhaps even more significant there on that. But they landed a contract from the U.S. Air Force versus on the kind of next-gen fighter aircraft, I guess. Boeing did. So that's good for Boeing, I guess. Not as good for Lockheed Martin, which didn't. they were the other ones up on that, and that did not happen. So they're down about 6% today. But the thing is, on that Boeing one, it wasn't just today. I mean, it was running up pretty well even before today. So there's that. We had some earnings that came out this week that I think were significant. Most of the earnings this week were actually yesterday. The significant earnings I can think of this week really were yesterday. And one was, interestingly, Micron, which didn't seem to have a bad earnings to me in terms of the numbers, but this is what we've got. Let me change the time frame on this chart because I want to show you something. Why you have to be a little cautious of, and I tweeted on this earlier today, in fact, as well. Why you have to be a little cautious after hours trading? Because I was looking at Micron as earnings came out. This was yesterday. This is a 5-minute candle chart here. And look what happened when earnings was released. It jumped way up. All the narrative was very, very positive on Micron at this point. And then it kind of settles down a little bit. That happens. And then it settles some more and settles some more. And then it kind of goes beyond settling more to actually just getting hurt big time today. Down 8% today after being up, I don't know, 6% or so after hours. Maybe more than that after hours. So moral of the story is you got to be a little cautious on those aftermarket moves. There's been times when I've kind of flippantly said, when the stock's up after hours, that's going to be way up tomorrow morning when it opens. That didn't happen there on Micron, did it? I mean, if you just look at the normal chart, you're looking at this and going, oh, gap down. You didn't see the after hours move there on that, okay? So there we go. So that was one that came out yesterday. All three, as I mentioned, were yesterday. Another one was Nike. Oh, Nike has been another stock, kind of like Boeing, that has just struggled for a while. They tried the whole kind of direct to consumer thing. Let's cut Foot Locker out of the middleman role. And it hasn't seemed to pay off for Nike. They've really struggled. Expectations on Nike were already, I think, pretty low, but they even failed on that. So that is, we'll see if they can turn it around. Obviously, they still have a strong brand, but like Hoka and On Cloud shoes are really, proving to be strong competitors to Nike. And the other stock that came out with earnings yesterday, which didn't fare very well, down 6%. You can see actually intraday it turned out okay. Let me zoom in a little bit. After a strong, a run down, is FedEx. FedEx, this is maybe a little bit concerning because FedEx is often seen as kind of a bellwether, so to speak, of economic activity. And if you think about it, it makes sense. They do the shipping for all these other people. And their forecast wasn't good. And so that's another stock that is in the news. So that was the earnings calendar this week. Those were the three biggies, I'd say. You can look at the earnings calendar if we go to calendar and see there's just not that much. I mean, it's not really earnings. I mean, I don't know. I don't know when the earnings season officially ends. I know it starts, but not when it ends exactly. But you can see this is the S&P 500 coming up next week. What's today? Today's the 21st. Was that McKesson, Cintas, Dollar Tree, Paychex, Lululemon? No huge names. No huge names coming out next week on earnings. So probably I'm not going to even bother looking at anything else on this. On the economic front, I already mentioned one thing, and that was the FOMC meeting. That occurred last Wednesday. The other economic news, the biggest piece of economic news, was retail sales came out last Monday. And that wasn't good. They missed on retail sales numbers, and that's the concern in the economy right now. Well, one of the concerns, right? I mean, the worst case is that we have a strong slackening in the economy that hits like the labor market too. Consumer demand goes down, unemployment goes up. That would be a bad scenario. I'm not saying it's going to happen. That's the fear. The worst thing would be if we had that and inflation. all that together, we'd call stagflation, right? Uh, High unemployment, high inflation, stagflation, that is not what we want to see. And I'm not saying we're seeing it right now, but that is kind of the scenario that people are worried about. That's why people are concerned about numbers like the retail sales numbers we had coming out Monday in the market. So Monday, we're going to have both manufacturing and services PMI. Love your comment there, Ron. It's always good, that's one good thing about joining live, people, as you can see the comments that come across in the chat. Very good. That certainly can affect the market. On those PMI numbers, whenever you see those PMI numbers, 50 is kind of the benchmark of, if you're below 50, it's contractionary. If it's above 50, it's expansionary, which is what the expectation is. I don't remember the exact numbers. It's around 51 is about what the expectation is there on that. So that's something to look for on Monday. Thursday, GDP. Okay. I should have brought up, and I didn't. I don't know why I didn't. I'm not going to spend the time to do it right now. I should have brought up the Schwab. On the Schwab.com website, there's a great economic calendar. Okay. There's a great economic calendar on Schwab.com. So if I try and remember, Ben shows it a lot in this webcast, and I didn't bring it up, and I'd have to log in and everything at this point. So, but we got unemployment. Excuse me. No. We got GDP coming out Thursday of this coming week. Now it's the GDP that is the final GDP. You know how those GDP numbers work? So they're like quarterly numbers. So the Q4 numbers say we get for Q4 GDP. What happens is in January you get I just did an in. That's supposed to be an in. January, you get what's called advanced GDP. Okay. You get what's called advanced GDP. That's the one that tends to move the market the most. Okay. Because it's the biggest surprise. And Journey77 said, yeah, you can also go to the Market Watch tab. Yes. On the economic calendar, you can pull up on the calendar, you can pull up economics there as well. Okay. January, you get that advanced GDP. February, you get, what do they call that? Preliminary, I think. I think it's called preliminary. Preliminary GDP. That's like the first revision of that advanced numbers. And then March, which is where we're at right now, March, you get what they call final GDP. And they just revise the previous numbers, take them up or down on the data that comes in. So when you're talking about GDP numbers, the first one after the quarter is the biggie. So next month, April GDP will be one of those biggies. Okay. August GDP, let's see, April, May, June, July. August GDP would be a big one, and then October, I think. Okay. So anyway, so GDP is a big report, but it's not as big as it could be because it is the final GDP. And then the biggie, another biggie next week that a lot of people are going to have eyes on is that PCE report. That's an inflation report, the one that Fed likes to keep their eyes on. And so, as I mentioned, inflation is a huge concern in the market right now. So that could be a market moving event. GDP could move in a market. PMI can move a market. PCE on Friday could move the market. And of course, there's all this other news that can move the market, such as news on tariffs. I guess there was some, President Trump today mentioned that there was room for negotiation or something today, but it's hard to keep up with it because there's frankly, a lot of messaging up and down in terms of the tariff narrative. And so the markets are strong. That's one reason why that VIX is probably elevated, to be honest. I want to look at the sectors because I think we've gone through the earnings events. We've talked about the economic calendar. I want to look at sector performance to kind of finish us up for the day here. I talked about individual stocks in the news. I think I've jotted them down, and I think I've hit the ones that I really wanted to hit. So, actually, there's one other thing I want to do before we hit sectors, and that is look at the pullback we've had, because this is the SPX, the pullback we've had, and talking about, is this a change here in the markets? So I want to just go back and look at some historical ones, and I'm going to go fairly quickly, but let me go to I'm going to go to a 5-year chart, but I'm going to go to a daily chart just so we can see the data in daily data. And on this chart, I marked some pullbacks. I'm going to zoom in here so you can see them a little better. Okay. And what I want to talk about is what it looked like historically after the pullback, what the turnaround looked like. Because it's not like red light, green light, all of a sudden we know it's obviously we've hit the bottom. You never know until, without hindsight, you don't see that happening. So, and look, I don't know where the market's going to go, but I figure if we can look at some of these, maybe it's a little bit helpful. This was about a 20% pullback. This was back in 2022. 2022 was not a good year in the market. We had about a 20% pullback. I marked it right here on this, and you can see, what did we have? It went down, rapid decline here, kind of a little bit iffy, but then we had several days in a row, little pullback, and we established higher lows on that, okay? Higher low, about an equal low, and then higher low, and from there it went up, okay? For a while, at least. Then we had another pullback, okay? This was a similar type pullback here, like a 20% pullback on it. That's a big pullback. We haven't seen those for a while. That's like another 20% pullback. What did we get? On that one, we actually, after the low was actually a huge, massive, bullish engulfing candle on that. A little bit at selling the next day, but then it continued up, and we had some series of higher lows and higher highs at that point. Let's go forward to the next pullback I had here, okay? I marked it on the chart to make it a little easier to see, okay? So this one, not as big a pullback. This one was about a 10% pullback. This was in 2023. How was it? Look, very strong bottom right here. And then boom, 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 boom. This is the easier pullback, the easier to recognize return to normal, when you just get massive days up, one after another. Not and we're not seeing that right now, are we? We've seen that kind of more sideways move. This was a smaller pullback. This one was only about a 6% pullback, but you can see we started that higher high, higher low thing. And then in October, we had about a 10% pullback. This is October of last year, 2024. Big pullback, gap down. And, sometimes we talk about the term capitulation in the market. And, it's like when the market finally gives up, it gives up and you saw that with this big gap down, gap down, and then a nice strong move up. Well, we're not seeing that right now, are we? That doesn't mean we're not having a turnaround. What it means is that it's not looking like this turnaround right here, okay? Or like the one before that, not that one, this one right here, where we just went straight up, and it would seem to be a lot easier to recognize on that one. Today, we went up, and now we've kind of just flagged, we've gone sideways. So we'll see the next move up. We've already kind of talked about this, so I don't want to go into it too much, but this is kind of the zone we're in. Break below that, probably bad news. Break above that, probably good news. Okay, let's look at some sectors to finish us up today. Because, sector performance is it, it kind of depends. Let's go to, we'll do that. And, energy has been strong. Here's our sectors. Okay. Here's our sectors. Energy has been the strongest sector this year, I think. Okay. It's done fairly well. Let's do what we did before. Let's do year to date and let's do a relative strength on it. How about? So let me go up here. I'm going to go back to that year to date chart. Here. I'm going to make that a percentage chart here. And I'm also going to throw on a relative strength line. Now, for this relative strength, for those of you who aren't familiar, this is showing how this is compared to our benchmark, which in this case is the SPX. You can customize that if you want. But if the line is going up, it means it's outperforming the SPX. If the line is going down like it did here, it was underperforming the SPX. Okay. If it's going kind of sideways, we'd say it's doing basically roughly what the SPX is doing. I'm starting off with energy, up 6% this year. That's not so bad, is it? What have we been doing lately? Because, year to date that's a fairly long period of time. And what would happen at the beginning of the year isn't maybe as relevant for right now. But what's happened lately, look at that relative strength line. You can see how strong energy has been of late. So that's, in terms of sectors, that is one of the outstanding sectors. Let's look at materials. Materials, and just a reminder, energy was up 6.2%, just as kind of a benchmark here. Here's materials. Materials hasn't had a bad year. I mean, it's up 2.7% this year. Not terrible. Today, not so hot. We're off the lows. Okay, kind of, that's nice. We closed near the highs. We like to see that. Was gaining strength to the market. Definitely has been gaining strength. And when the market was pulling back, and that's why sometimes when you're using a comparison chart, it can be hard to see, or just going, well, it's going down. Well, the whole market's going down. So even though this has been going down here in this time period, this was actually relative to the S&P 500, it was actually outperforming, okay? But it's actually fallen down just the last few days here. It's underperformed the last few days. Industrials, basically break even for the year, up about 0.5% for the year. Was outperforming, basically going with the market the last couple weeks here. Discretionary, terrible. Nothing against discretionary, but that's where those concerns that I've been talking about of economic softness coming in, that can certainly affect discretionary as, in a significant way, and certainly it has. We're down 12, 13% this year on discretionary, and it hasn't been getting a little bit. We got a little bounce here the last couple days, but the trend is not discretionary's friend right now. Now, staples, very different. Staples is up about 1.5% this year. It has tailed off lately. So we'll see. I mean, that's probably a meaningful time frame. I said a full year time frame may be too long. A few days may be too short, but from here to here, that's starting to get into the couple weeks category of staples underperforming here. So when you're looking at different potential investments, that's, that may be a factor on here. Healthcare has done great this year, 6%. That's up close to what energy has been doing. That's great. And flat lately, but overall for the year, pretty good. I need to finish up. Financials up about 2%. This year, gaining some strength lately. IT, this is one interesting one, down 9% this year. Remember those Mag 7 stocks? Well, they're not all IT, but some of them are IT, some of them are IT adjacent, I'd say. Holding its own the last couple weeks, but really low this year. Communications, based down 4% this year. Utilities, up about 2.5% this year. And real estate, up about 2% this year. Has gained some. I think some of that may be interest rates. Interest rates, the lowering of interest rates of late, we looked at that earlier, has probably been a little bit of a tailwind for real estate. Okay, and with that, we're gonna, I think, call it a day here, or call it a week. Everybody, it'll be interesting to see what happens Monday. I want to thank Cam for helping me out in the chat. Follow us on X at Brentmore CS, at Cameron May CS. Everybody, I hope you all have a wonderful weekend, and we'll see you all same time next week. Bye-bye, everybody.